Namaskar. This is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. The Financial Express the other day carried three correlated and interesting headlines, which to us show the emerging state of the Indian economy post the pandemic and amidst the ongoing global economic slowdown. The first report about the overall state of the world economy and of a few key national ones comes from the IMF. It says that the IMF has slashed its global growth projections for 2022 and for 2023, and it has warned of a possible worldwide recession next year. It says that the global real GDP growth will drop to 3.2% this year, down from its earlier estimate of 3.6%. The IMF pointed out that the global GDP actually shrank in the second quarter of this year, and that has been because of a downturn in Russia and in China. According to the IMF, the risks to the global outlook are overwhelmingly tilted to the downside, thus indicating a likelihood of further downgrades in the global growth outlook by it. The second point it says is that the IMF has scaled down its global growth forecast for 2023 to 2.9% from its earlier forecast of 3.9% made in April, highlighting the damaging impact of tighter monetary policies on growth across key economies. It then mentions several shocks which have hit the world economy, which is, according to it, already weakened by the pandemic, which is also further shocked by the higher than expected inflation worldwide, especially in the US and in major European economies, which have triggered tighter financial conditions. It mentions a worse than anticipated slowdown in China, reflecting COVID outbreaks and lockdown. And it also mentions the impact of a further negative spillover from the war in Ukraine. The fourth, the IMF therefore says that the risk of recession is particularly prominent in 2023, when in several economies, growth is expected to bottom out. Household savings accumulated during the pandemic are expected to have declined further, and even small shocks could cause economies to stall during this period, showing how fragile national economies are today. It further mentions the worsening economic prospects in the US and China, and in the fastest growing economy, India, which have driven the IMF's downward revision of the global growth rate for 2022, as we just discussed. The IMF cut its US growth forecast for 2022 by 1.4% to 2.3% now, due to the dampened household purchasing power and tightening monetary conditions there. It expects China to grow by 3.3% in 2022, which is its slowest pace in 4 decades. And in doing that, it has cut its earlier growth estimates by 1.1%. The economy there is slowing sharply. The IMF also trimmed its real growth forecast for India by 80 basis points each for financial year 2023 and 2024 to 7.4% and 6.1% respectively from its earlier projections which were made in April 22. The IMF has revised India's growth rates, and that revision has been downwards because of less favorable external conditions and more rapid policy tightening by the Reserve Bank of India, which is anti-growth. And finally, the IMF revised its global inflation forecast, citing elevated food and energy prices, as well as lingering supply-demand imbalances in the wake of the Ukraine war. It expects inflation to reach 6.6% in advanced economies and 9.5% in emerging and developing economies, showing an upward revision of about 0.9%. No letup from inflation that we are facing. The key takeaways from the IMF global outlook are that a recession is imminent in key economies, failing which an economic slowdown has already set in. Inflation is yet to peak out, and it will rise further, provoking central banks to tighten monetary policy even more, thus aggravating the recessionary trends in the global economy. household savings stand eroded, and a sharp slowdown in consumer spending is on the cards. Those are the takeaways from us from the IMF recent report on the global outlook on the world economy. In the case of India, the IMF is not the only one to have downgraded the growth estimates for the current year. Many others, including Nomura, the OECD, FICCI, Reserve Bank of India, the Asian Development Bank, Morgan Stanley, CRISIL, Standard & Poor, Fitch, and the World Bank, they have all pruned their growth estimates for India for the current financial year 2023. Some have done it moderately and many have done it sharply. Talking about the diverse impact of such slowing and uncertain macros as the IMF reports are two different reports in the Financial Express. The first one is a set of news items about the record profits of large Indian companies across the board. And the second one is about the closure of MSME units in India. About corporate profits, the Financial Express reports a substantial jump in the profits of a few big companies which defy any kind of a slowdown in the economy that the IMF speaks of. And we are talking about reports in the Financial Express on a single day. There are many other reports on bountiful corporate profits, but we are just talking about the ones that were reported that day. What are these reports? The first one, the profits of Bajaj Finance for the June quarter jumped by 155% from 993 crores to 2533 crores year on year, beating street estimates. Its net interest income shot up by 48%, aided by a 60% increase in new loans sanctioned during the quarter. It also recorded its highest ever increase in its customer franchisees. The second report, in the case of Asian Paints, the quarterly profits soared by about 80% on good consumer demand, beating market estimates. With an increase in its sales from 5,534 crores to 8,578 crores year on year, its net profit shot up to rupees 1,017 crores for the quarter, indicating a robust top line as well as a robust bottom line. The third one, Tata Power reported a net profit of 884 crores for the quarter, which is a 90% increase year on year. The rise in profits was driven by an improved performance of the company in all sectors, including power generation, transmission, and distribution. It has spurred the company to line up a capex plan of rupees 14,000 crores for the year. The fourth report, the engineering giant L&T reported a 45% rise in its quarterly profits despite the June quarter being a seasonally weak one. It was due to a much improved performance in all its major businesses. L&T's performance beat the Bloomberg analyst consensus. The company mentioned that there has been a distinct improvement in the company's ordering environment, showing that its business prospects are good. The fifth report, global soft drinks major Coca-Cola said that its India business recorded the best ever volumetric growth in the June quarter, showing increasing sales in India. The next one, Unilever says that its India sales grew strongly by 8.1% in the first half of this year. Of its three priority markets, the sales of USA and India grew strongly, while the sales of China were affected by the lockdown in the June quarter. And finally, the Adani Group announced that it will invest $70 billion in green energy in India. So while you look at these corporate results and announcements, it looks hunky-dory for the big companies in India, but it is not so for the Indian MSME and the unorganized sector, which continues to struggle to survive. The Financial Express says in its report that over 10,000 MSME units shut down between 2016 to 2022, of which 96% shut down in the past 3 years alone, confirming what it calls the ravaging impact of the pandemic on the sector. These are government figures, and thus the real number of MSME closures will be much more than this. It also says that several policy steps to spur formalization of the economy, including Measures to curb GST evasion have also adversely affected the labor-intensive sector, which is the MSME sector. It certainly means loss of livelihood for the small entrepreneur and massive job losses too for the MSME units. The government says that such closures are a matter of concern for it, but it is not aware of the reasons for their closure. Closure is one part. There have also been massive downsizing of their units by the MSME sector because of various reasons that they struggle for. The larger picture emerging from these three reports in the Financial Express, which is the report from the IMF, the corporate results reports, and the MSME closures, is that the first one, as we see it, is that there are two different and distinct worlds in the Indian economy. That is, the struggling small ones and the prosperous big corporates. The closure of the small ones has only added to the prosperity of the big sector. The market share ceded by the MSME sector in India has been gobbled up by the big corporates, which have got bigger and fatter in the process, explaining their record sales and profits. The second point, India may be emerging as the fastest growing large economy in the world, but the growth will primarily benefit the big sector. At this rate, the small sector will be reduced to a fringe player and the growth will largely bypass it, which is a matter of concern. The third point, while India is not expected to hit a recession, it is however slowing down. The big ones are however insulated from this slowdown and they will continue to expand and capture market share even in this slowdown, which has always been to the detriment of the MSME sector, which faces downsizing, which faces closures. The next point, the big companies have given us a jobless growth, and it is the MSME sector that has been the job generator. If the MSME sector languishes, India will struggle even more to provide jobs to the youth. That again is a matter of concern. And finally, inequality will continue to grow in society and in the economy. The poor, the smaller sector will continue to suffer. The MSME sector will continue to face challenges, but the bigger one will only grow bigger and more bountiful. That is a long-term worry as far as the economy is concerned and as far as the society is concerned. This is Akhilesh Bhargava signing off till we meet again. Namaskar.